Hi, in this video, in a very easy to understand fashion, we will discuss or analyze the way the lending interest rate system has evolved in India. Currently, we are at RLLR, which is repo linked lending rate. उससे पहले base rate था, MCLR था, जो भी था. We will try and understand that in a very easy to understand evolutionary sequencing manner. So before 1994, pre-1994, the interest rate was, the lending interest rate system was called administered interest rate regime, wherein RBI had the entire control, and they used to decide what would be the lending rate and what would be the deposit rates. So banks did not have any autonomy to take this business decision on as to what should be the interest rate on which they should give loans or accept deposits. That changed in 1994 when prime lending rate came into the picture. Now, prime lending rate was basically the rate on which you give loans to your prime customers. That is, whoever is your best customer, the rate on which you want to give the loan to them would be prime lending rate, and that would be the base. And for other customers, there will be prime lending rate plus some spread, that is prime lending rate plus 1% plus 2% would be decided based on the risk level and other factors of that particular loan case. Now, this prime lending rate had one issue, which was discrimination. That is, banks were giving loans at very low cost to the big corporates, but the smaller individuals or smaller businesses were getting discriminated and were paying a lot higher rate of interest because prime lending rate plus spread was in the hands of the banks. So in 2003, RBI decided that they want to change this, and they shifted to BPLR, that is benchmark prime lending rate. It started in 2003 and it was there till 2010. And in BPLR, basically, the prime lending rate, which we just discussed, became the benchmark prime lending rate. That means it became the standard. And but the problem again was that banks were giving sub BPLR rate of interest to the big corporates. That is BPLR minus 0.5%, minus 1% to big corporates. So again, the discrimination was happening. And second thing, which was a problem with PLR also and BPLR also, was that transmission was not happening. That is, if in case the RBI reduces their interest rates, the monetary interest rates, then that was not getting passed on to the customer, because banks had that autonomy to decide what would be their prime lending rate, irrespective of what is the monetary rates, what are the monetary rates. So in 2010, RBI thought that they will switch this to base rate system. Started in 2010. So 1994, pre-1994, it was administered interest rate regime. And then in 1994, they came up with PLR, which was prime lending rate. Then in 2003, they came up with BPLR. Now, PLR stayed from 1994 to almost up till 2010, and BPLR came in 2003 and also stayed up till 2010. But in 2010, both of these were replaced by base rate system, which was a minimum lending rate below which banks cannot lend. Was decided by RBI. So the discrimination issue, which was there in the previous lending rate systems, that was taken care of. However, there was still another problem with base rate, which was that the transmission was again not happening. That is, if RBI reduces the monetary rates, then banks were very slow to cut their base rates. And that was a problem in the eyes of RBI. The base rate was, just to understand how banks could delay reducing the base rates, I'll tell you the components of base rate. So base rate consisted of the cost of funds plus the operating cost and plus the minimum profit margin, which they decide. So every time the monetary rates go down, that means the cost of funds go down for RBI, but operating cost and minimum profit margin were still in their hand to decide. And using this, they were delaying reducing the rates for the normal customer. So in 2016, RBI came up with another solution, which was MCLR, which was marginal cost of funds based lending rate. In this, the marginal word means latest. So lending rates were based on the latest marginal, that is the latest cost of funds, and not the average cost of funds. In the previous base rate, the cost of funds was the average cost of funds, and that's why banks used to uh, delay changing them. But here in MCLR, marginal cost of funds, the cost of funds would be the latest cost of funds for the bank, and different MCLR pockets were given. That is overnight MCLR, 1 month MCLR, 3 months MCLR, 6 months MCLR, and 1 year MCLR. And the loan rates were revised periodically. That is, there was a reset clause in all the loans which were given to the customers. So in a way, this had a faster reflection of any change in repo rate or monetary rate by the RBI. However, it was still partial transmission. The repo rate change will not exactly be implemented on the interest rates of the customers, because obviously there is, other than cost of funds, there is operating cost and minimum profit margins, which the banks were deciding in these rates. So in 2019, the RBI came up with this solution, or with the lending rate system, which is currently ongoing, which was RLLR, or also called as EBLLR. EBLR means external benchmark linked lending rate. Now, EBLR means that loans or the interest rate would be linked to external benchmark. One of the benchmark is the RBI's repo rate. So if the repo rate is used as the benchmark, external benchmark, then it is called RLLR, repo linked lending rate. Other than that, there are two more options. One is 3 month or 6 months T-bill yield can be used as the external benchmark, and any other RBI approved benchmark can also be used. However, in practice, almost everyone is using repo rate as the external benchmark, and hence RLLR, repo linked lending rate, is the most common lending rate, which is currently being used all across the industry. The benefit, or where RBI won with RLLR or EBLR, is that the transmission right now is very quick and very transparent. The moment repo rate is changed, the interest rate of any individual or all individuals or all borrowers will change in the exact form. So under repo rate, it will be repo rate plus some spread. So the spread could be different for anyone, for everyone, for all kind of borrowers, but the repo rate remains same. If RBI cuts the repo rate by 0.25%, then everybody's interest rate would be down by 0.25%. So transmission was very quick, is very quick, and is very transparent, and that is why RLLR is almost a win-win situation for the borrowers, for the RBI, and in a way for the banks also. So that is it regarding the evolution of lending interest rate systems in India. Very quickly, I'll revise it. Before 1994, it was administered interest rate regime, where RBI used to decide what will be the loan interest rate and deposit interest rate. In 1994, prime lending rate was introduced into the picture, which was sort of modified in 2003, and it was a benchmark prime lending rate, BPLR, was introduced, which is prime lending rate was basically the rate on which you will give loan to your prime customer, which would become the base. And in benchmark prime lending rate, that lending rate became the benchmark and will be used for all of the loans also. Not much of a difference, but 2010, it was changed. A major change came when base rate came into the picture, wherein three components are involved. One is cost of funds, which was linked to the repo rate of RBI, or the monetary rate of RBI. Second is operating cost, and third is minimum profit margin. Operating cost and minimum profit margin was for the banks to decide. Then after little from 2010 to 2016, base rate system was applicable, and 2016 onwards, MCLR was introduced, which was marginal cost of fund based lending rate. Here there were buckets: overnight rate, 1 month, 3 month, 6 months, and 1 year rate, and there was reset. They were to be reset periodically. So there was faster transmission of the monetary rate changes, and also marginal here means latest. So the cost of fund has to be latest and not the average of a longer period can be taken. So it was more transparent, and transmission was higher than all the previous regimes, all the previous interest rate systems. But finally, in 2019, the EBLR, external benchmark linked lending rate, came to the picture, where there were 3 categories of external benchmarks which can be used. One is repo rate, second is 3 months or 6 months T-bill yield, or any other approved benchmark, any other RBI approved benchmark. However, almost everyone is using repo linked lending rate. So RLLR is the norm right now. The major benefit of RLLR is that here it is directly linked to repo rate. So if repo rate goes down, the interest rate of the borrower has to go down. So the transmission is super fast and it's very transparent. So a win-win situation for everyone. That is all for this video. In the next video, we will discuss what is interest rate and what kind of discussion points can come in your day-to-day life, like if you're attending a meeting and some decision related to interest rate has come into the picture, you need to know what is interest rate and what are the components of interest rate and what are the forces behind any modification in interest rate. So in the next part of the video, we will discuss that.